Speak up if I missed you. All right. So without further ado, our guest of honor today is Sarah Sheevy.
Mhm.
Sarah is with Black Horse CPAs, and she's been our personal CPA, my company CPA, my husband's CPA with his company, and our family CPA. I don't even know how many years now. Based out of Missoula, Montana. California girl moved and is not coming back,
Mhm.
she told me. And she's taken really good care of me and our family. And when I offered this to her, she got super excited, which I thought was awesome. So I'm going to hand it over to Sarah. She's going to do a presentation. And when she's done, then we'll open it up to Q&A. But feel free to put them in the chat so that you remember what your question was. And I'll help moderate, Barb can help moderate, and we'll go through and um, find out what Sarah can teach us today. So Sarah, the floor is yours.
Awesome. Thank you, Nancy. Thank you guys for having me. I'm super excited to be here. So Nancy already knows if you ever meet a numbers nerd in their life, I'm probably going to be the number one most enthusiastic one. Like she said, my name is Sarah Sheevy. I am a CPA, which is a certified public accountant, and I'm also a principal with Dark Horse CPAs. I've been with them for about 4 years. I've been in the industry for about 16 years total. And I'm one of those humans that was just born with a puzzler mind. I love the balance and organization of accounting and tax. So I think of my job a lot of times as a Sudoku puzzle on steroids. And my goal is just to save my clients as much as we legally can in taxes. And I just get a lot of fulfillment generally out of helping people take something as scary as the IRS and put them back in the driver's seat and let them feel a little bit more in control. And just help explain all the questions that on the internet you always get the answer. Well, it depends. So I'm really looking forward to going through stuff today with you guys. So it was great having a little intro from each of you. Definitely a lot of LLCs and S corporations just starting out. So I already have a running list of what I know will probably be like 3 more questions at the end of this presentation. But yeah, so the plan is going to be I'm going to try to take about 15 minutes and kind of hit some overall topics for you guys. And then I will stay until Nancy kicks me out answering your questions. So let's dive into this. All right. So one of the fun things about business is there are so many aspects of it that we are just never taught in school. Whether you went to college, like unless you really specifically went to college specifically to learn this, they rarely talk about it, or they don't talk about it in a way that's actually going to make sense to you tactically when you're diving into this. So a couple of the things that we're going to go over today at more of a high level: tax management basics. We're going to get into what kind of things should you be tracking? How do you even know what you're supposed to be doing? Record keeping and bookkeeping in general, and just why that matters so much. Financial stability, and yeah, overall long-term success and peace of mind. And what kind of things you guys should be taking action on if you haven't already. So let's dive into this. All right, so the number one thing that overwhelms a lot of people when they first start businesses, or they're just generally new to being freelance or being a business owner, is how many compliance deadlines exist in the world today. Especially if you're in a state like California, there's even some extras on top of it. So one of the number one things that I recommend for clients is to build out a calendar specifically for compliance deadlines and tax due dates and just all of those pieces that are always running around. It's one of those things where it's better just to just get it in your calendar once with that recurring reminder, and just you're never going to remember them all on your own. So a lot of the ones that I've got on here, they're not going to apply to everybody necessarily. So like payroll tax returns, for those of you that are just sole proprietors, if you don't have employees yet, that's not something you're going to be worrying about. If you're in a service industry, you probably don't have sales tax returns. But at the end of the day, I find it to be something that really calms a lot of the anxieties of being a business owner, is just to have everything you need to do in a year already mapped out. So, and for most people, what I recommend, because things do depend, depending on your industry and your business and where you're located, is to get together a list of your deadlines and then have whoever it is that helps you with your taxes, like, your accountant, whoever it is that you are working with, have them just kind of scan over it for you and just help make sure you're not missing anything. So I will drop it in the chat at the end here, but I did put together for you guys a bit of a cheat sheet with all of the most common ones that I see specifically for California business owners. So I will share that at the end so that you guys can kind of start this sheet yourself. Okay, so record keeping, the dreaded bookkeeping, record keeping, accounting that just makes most of my clients' eyes just like roll into the back of their head. So let's talk about when you are doing record keeping, there is always this gold standard of what the IRS is going to require if you get sucked into just like a hardcore audit. And then there's a whole lot of a grayscale between what is the absolute perfection that you could be doing and the reality of what people are actually doing. So we're going to kind of take this from a bare minimum and you're going to build on as much as you think you're going to be able to actually bear and realistically do in your day-to-day life. And we're just going to see how close you can get to that gold standard. So the absolute bare minimum, though, is not commingling. And what that means is, especially for sole proprietors, this is something that I see a lot. You really do need to have an entirely separate business checking and credit card account than your personal funds. Commingling, that's a term that we use for when you pay for business expenses out of your personal account or you pay personal expenses out of your business account. And your accountant spends lots of hours then detangling that on the back end because we still have to sort through that at the end of the day. And what a lot of people don't realize is if you are commingling, the big scary risk there that a lot of people don't know about is even if you have an LLC or a legal entity that you operate your business through, if you have been commingling, especially if you're really bad at commingling, they can do something that's called piercing the corporate veil, and you can essentially lose your liability protection. And basically what's happening in that scenario is they're going to say, you can't just buy an LLC and then do whatever you want. You have to actually treat it as its own entity for it to have its own protection. So if you treat it just like a second piggy bank, then really if you got stuck in a hard audit, they could entirely take away your liability protection. So that's why that's the number one bare minimum is today, if you don't already have separate business banking accounts, separate business credit card account, you need to set that up. And I will say, even if you are a sole proprietor, no LLC, maybe you operate under a DBA, you still are going to want to set up a separate business checking. So that's number one. Phase into this, most people that I work with are on QBO, and that's how they're keeping track of their bookkeeping. I would say that the bare minimum is that you have some kind of accounting software that's happening if you have more than 15 or 20 transactions a month. And what I mean by that, anytime that you swipe your debit card, anytime you receive a sales deposit, that's one transaction. So if I look at somebody's bank statement, most people have somewhere between we'll say 50 to 100 transactions. And that's obviously way too many transactions over the course of a year to try to be tracking just in a spreadsheet. So if you're not on something like QBO, there are a lot of other great, cheaper, freer websites out there that'll do something similar. But I do recommend at the bare minimum that you have some kind of accounting plan in place. Overall, I would say most of my clients that I've worked with in the past that owed massive tax bills and they didn't have the cash to pay it and were just generally in a really bad situation. One thing that they all have in common is that their records were just a mess. They really business expenses were coming out of all different accounts. They didn't really have solid bookkeeping in place. There was a lot of commingling happening. And when that happens, the other effect that you have with that, besides making tax time just a nightmare, is it's virtually impossible to do any kind of tax planning because you don't know what you're making. You really don't know what your bottom line is like if you're only looking at your numbers once a year or 6 months after the end of the year. So you really lose a lot of opportunities. And even worse, if you let that much time goes by, you're probably going to forget about some business expenses that you could have legitimately taken. So that's my number one bare minimum for anyone that's in a business: separate bank account, have a plan for how your bookkeeping is being done. And then I'll also throw in there, keep in the back of your mind that you need to be tracking at least your major purchases. And by major purchase, That's a vehicle. It could be a lot of new office equipment. Anything that you need a loan for is probably going to fall in that category. So taking that one step closer to the gold standard, it really starts to come down to how it is that you're tracking your invoices and your receipts. So at a bare minimum, if you just have like one business email, I have a lot of clients that they'll actually, like whatever their business domain is, they'll set one up specifically that's called like accounting@company.com or something, or, you know, whatever their domain is. And they just have every single thing that they purchase get sent to that inbox. And then if they ever do need the receipts, they're just there waiting for them. So that's a really good thing to keep in mind. And then just to talk about the IRS's actual gold standard. So if you were to fall into a pretty hefty audit, the gold standard, they can ask you for receipts on literally every transaction. Depending on the auditor, there is some leeway there. Some auditors are like, well, if you've got the bank and credit card statement and you can like really clear, like your records are in order, you can show me how you got to the numbers, that's going to be enough for them. But there are other auditors that they really are going to press you for every single receipt. So I have a handful of clients, and I'll be honest, it's only a handful that actually goes so far as to meet that gold standard where their receipts for everything, they're not just keeping them, but they're actually using that QuickBooks function where you can attach a receipt to every transaction. So that really is the gold standard for record keeping. And I say, so that's kind of your scale from bare minimum to just beautiful gold standard. And most of my clients, it comes down to what will you actually do? And just like kind of where is your threshold for risk, and just kind of being aware that there could be a potential that you might lose some deductions in the case of an audit if you're not keeping track of all of that. So I kind of leave that for my clients just to kind of see what you can stomach there in between. So there is definitely some leeway there. And there we go. So another question I get all the time from clients, especially when they're starting new businesses, is how are they supposed to pay themselves? This is a really fun topic for me because it really does depend on your structure. So we're going to kind of hit some of the main ones that I heard you guys shout out today in our intros. And this is also a topic that is kind of funny because I just eat and breathe the tax form numbers and everything, but a lot of my clients, you'd be surprised, really use things like 1099, W-2, owner's draw. They kind of use those terms interchangeably. And they each actually mean something very specific, and you can run into issues if you're doing the wrong one. So let's talk some tax forms for a second. So if you are a true freelancer, and what I mean by that is you're either a sole proprietor, you don't have any kind of LLC or anything, maybe you're working under a DBA. If you're a single member LLC, which is basically an LLC that's being treated as a sole proprietorship, you file a Schedule C on your 1040. That's what we think of when we say like a freelancer. So your payment is going to come in the form of a 1099. They're not going to be deducting any payroll taxes. They're not going to deduct any federal withholding. It's 100% on you to pay both your payroll taxes, just 15.3%. That's where self-employment tax comes in. And it's completely on you to pay your own quarterly estimates. I was going to kind of throw out there. So the IRS loves their forms. I think they're terrible at numbering things personally. It doesn't actually make sense. A W-9, that is actually the information form that you submit to a company that just gives them the information they need to issue you a 1099 at the end of the year. So it's just that simple form that's just your name, your address, and like your tax identification number. That's the W-9. You give them that. They give you back at the end of the year, the 1099 NEC, or sometimes a 1099 miss, depending on what you do. So that's your first bucket. Second bucket is like true payroll. And so when we're talking about payroll, that's an employee of a company has handed them a W-4 form, which is informational. It's just your name, address, your tax identification number, your withholding decisions. And then at the end of the year, they hand you your W-2. That's probably the one people are most familiar with because pretty much everybody has been a W-2 at one time or another. And so with payroll, the big distinguishing factor, obviously, is that payroll taxes are being withheld for you, which means you're not going to be dealing with self-employment tax. And they almost always, unless you jacked up your W-4, are also going to be taking federal and state withholding out of there for you. So, and then the third bucket, we've got our owner draws. And an owner's draw, that is neither 1099, it's not payroll. That's literally a business owner. Let's say you close out your year, you profited $100,000 at the end of the year, you've got that cash in the bank. Maybe you want to pull 50,000 of it out, and that's just really just your profit that you're moving to your personal account. That's a draw. So now let's do a couple example scenarios though. So those of you that do own S corporations, or any of you that have actual employees that work for you. Yeah, let's go if you're an S corp, let's say. So an S corporation is so super fun because you actually wear two hats in that company. You are a business owner and you are also an employee. So S corp owners are a little bit different because you're going to get both a W-2 and you're also going to be taking owner draws. And we'll kind of get into this at the end. I'll kind of expand on this more, but that's actually why S corporations have a tax advantage for a lot of freelancers. It's because you're able to kind of offset some of the payroll taxes you would normally pay if you were just straight 1099, and you're able to take owner draws instead. Because owner draws, you don't pay taxes on owner draws. And let me kind of expand that a little bit, because this one always kind of just like plays with people's minds a little bit. So you've got two hats, right? You're a business owner is one of your hats. At the end of the year, you're going to calculate what was my income, what were my expenses, what was my net income at the end of the day. The taxes that you pay, it's going to be based on that net income. Okay, so that net income, let's say that's sitting in your cash account. Regardless of what you do with the cash in that account, you still owe taxes on what your net income was. So if you take that cash and you decide, I'm going to pay some to my credit cards, I'm going to pay down some loans, and I'm going to take some owner draw, that's not going to change what your taxable income was and what your tax is going to be. So that's what I mean when I say owner draws aren't taxable. It's that they are not involved with the calculation of how much tax you owed. So that's a high level there. A lot of you are both a freelancer, maybe you're getting 1099s from another company, but you also have freelancers or subcontractors working for you. So in that case, you guys are going to be both receiving 1099s at the end of the year, and you're also going to have a responsibility to mail a 1099 at the end of the year to your subcontractors. So that's one of the things I have on that master deadline sheet I'll send you guys at the end of this is 1099s. They're due on January 31st every year. So something to keep in mind for sure. Okay. So financial stability as a contractor. Being a freelancer can definitely be a little bit intimidating. And part of the reason why is that if you come from a background where you're used to being a W-2 and an employee, you're used to money being deposited into your account after somebody already paid the taxes on it for you. You've already had payroll taxes taken out. You've already paid your withholdings. So whatever actually gets deposited into your account is yours to use. And then as soon as you step into the freelancer world, though, that immediately stops being the reality. So now you're getting money deposited into your account and you owe payroll taxes, which is going to be 15.3%. That's self-employment taxes. And you're also still going to have to pay those federal withholding taxes yourself. So the real reality on average, obviously every business is different, overhead is different, but on average for every $3 a business owner makes, $1 is paying your overhead, your expenses, your employees, $1 is paying the government tax time, and then it's $1 that's actually going into your pocket that you can spend. So the biggest thing that sets freelancers up for failure is not realizing when that money comes in your account that it is not payday for you yet. It's time to pay your bills, it's time to pay the government, and then you're going to actually get to pay yourself at the end, which is another reason why having separate business and personal checking accounts is incredibly important, because it's very different when you see money coming in your business account versus that 1/3 that you end up actually transferring to your personal. Saves a lot of heartache just kind of having those separated and just having your mindset separate when you're looking at each of those. So yeah, on average, this obviously depends on what other income you have going on, how much business you do, but on average, most people need to be saving 30% of any 1099 invoice that they receive payment on. So yeah. Okay. So this is one of my favorite things to talk about, which I know sounds super dry. But let's talk about long-term peace of mind versus short-term tax savings. And what I really wanted to get into here is a couple of different approaches that there are to audit protection. So obviously, you could cheat and lie on your taxes and owe like $0, and that would be an incredible short-term benefit. You'd have a ton of money in your pocket. But just like any life of crime, it's really best, obviously, to keep your nose clean so that that money that's in your bank account, you're not always looking over your shoulder waiting for that IRS letter to just show up. So let's talk about that balance between tax strategy and planning and just like really legitimately paying as little tax as possible versus having that peace of mind that your money is truly your money. And if they come knocking, you have nothing to fear from it. So three main approaches to audit protection. Number one, it's just not doing anything stupid. That would be lying on your taxes and making up expenses and just maybe plugging like an extra 50,000 into medical expenses. Anything like that is just obviously a horrible idea. The number two is having your records in order, putting the time into your record keeping and your bookkeeping to make sure that you've really got true records that could defend you in an audit. And it's also just avoiding obvious red flags. So I won't spend a ton of time on this, but just to give you guys a couple of examples of like, what is a red flag? Because obviously everyone's horrified of getting audited. Examples of red flags that will almost always get a client audited. My favorite one is I've had some clients go out and buy a boat and want to claim it as just 100% business use on their tax return. Almost anytime the IRS sees a boat or a plane on your depreciation schedule, you're top of the list to get audited because virtually nobody buys a boat and actually uses it 100% for business. They're just way too fun. So that's one for sure. Another one would be for those of you that are filing Schedule Cs, so our sole proprietors, DBAs, anyone that's just a single member LLC. If you have a Schedule C and you are constantly showing losses, especially if you show losses more than 3, 4, 5 years in a row, that's also a pretty big red flag, and they're going to come in and check. Actually, something that not a lot of people know is one of the biggest reasons that clients do get audited is because of Schedule Cs. Why is that? Well, simply put, a Schedule C, all that the IRS can see is just your P&L, basically. They see your income, they see your expenses, and that's it. Versus if you take somebody like an S corporation owner, they're filing an entirely separate business tax return for the S corporation. That means that in addition to just the income and the expenses, they're also required to submit a full balance sheet, which is going to show the cash account balances, any loans that they have, what their equity in the business is. And basically, you can't file a business tax return unless you've done adequate bookkeeping versus a Schedule C. Clients can and do just kind of estimate it, kind of make it up, do it off of memory, and they don't always actually have any support for it. And so like because of that reason, Schedule Cs are almost always one of the highest elements of a 1040 that we see get audited. Which isn't scary if you're keeping your records and like all of your expenses are legitimate, but it's definitely not the area that you want to like plug that Disneyland resort trip and call it business travel because they will find it and ask about it. And then, so the final level of audit protection, which is a big thing that I did want to talk about today, restructuring your entities to make yourself as difficult to audit as possible. So what does that mean? So let's say one thing stuck out to the IRS on your 1040 and they decide to audit it. Let's say you had a lot of cash donations that year and they just want to check in on it. Once they open an audit on your 1040, they have free reign to expand that and look at any page, any line item, any element that was on your 1040. So if you're a sole proprietor and you're filing a Schedule C, they can come in to look at your itemized deductions or anything else. But while they're there, they can basically just like, stay and look around and they can go full on into your Schedule C. It's the same kind of thing if you have rentals, if you file a Schedule E. Versus for those of you that are an S corporation, you're now filing an entirely separate business tax return. All you're going to get is a K1 issued to you personally, and it's that K1 total that's reported on your 1040. So if the IRS comes in and they want to look, they're looking at your cash donations and they want to see where your business income came from, they would actually have to go through the work of opening an entirely separate audit on your business entity in order to see anything that's inside of it. So basically, as soon as you take something like a Schedule C or like even a Schedule E for a rental and you put it inside a business entity, and by business entity, I specifically mean a partnership, an S corporation, or a C corporation, it completely removes the audit risk of that business activity from your 1040. So can they still go audit that? Sure, but it takes a lot more work on their side. And generally speaking, it's our clients that had all of that stuff just sitting on a Schedule C or a Schedule E that find themselves getting hammered during an audit. The IRS is a little bit lazy sometimes, so they're a lot less likely to actually try to go through all of your entities than just go for the low-hanging fruit in a lot of ways. So the second thing that I wanted to bring up here, kind of related to that, is there is kind of a trap that I see a lot of freelancers fall into when they weren't kind of setting themselves up for success to start with, is this really vicious cycle where they weren't keeping bookkeeping, they weren't doing any record keeping, they don't know how much money they made. So then next year rolls around and they owe a bunch of tax for last year. Now they don't have any money saved. So now they have to take this year's money to pay last year's tax bill. Then they're going to get to next year and the whole cycle is going to continue again. I hate when that happens to my clients. And the easiest way to break that cycle is to, one, start keeping your records and your bookkeeping literally today. So if you have gone this whole year and you haven't done any bookkeeping yet, this is the time to get caught up. And then the big benefit there also is once you do have some bookkeeping in place, you can start doing tax planning and see what am I going to owe in quarterly tax estimates and start to kind of get ahead of that curve. So, okay, so one more thing to go over and then we'll open this up for some questions here. All of you that are into freelance, you guys are starting businesses. If you view your business as, unless you view it truly as just a side gig and you're just doing it for a little while and you don't plan on staying there for a long time, if you really are viewing it as a business, you need to start getting in place your professional team. And what I mean by that, so obviously as a freelancer and as a business owner, every single one of you specializes in something. Almost never is the thing you specialize going to also include lawyer stuff, tax attorney stuff, tax knowledge, wealth management. These are all very specialized areas. And rather than trying to become not only excellent at what you do every day, but also become excellent at all of those other things, it is immensely beneficial, obviously, just to start building that professional team around you to help protect you from what you don't know. So I wanted to do a couple comparisons because you can hire professionals at any price point, generally speaking. So I wanted to talk about some of the differences of like, when is it okay to go with the cheaper option? And when do you really need to find somebody like a legit professional to do something? So the first one, we've got a business tax attorney versus LegalZoom. So when does that business tax attorney come into play? Generally speaking, it's when you are setting up and creating entities. Definitely the majority of my clients usually choose to go through LegalZoom for stuff like that. The big distinguishing factor when I start leaning really heavily on my client to go find a legitimate tax professional or a tax attorney. LegalZoom, I am most comfortable with it if you are going to be a single owner. It is just you and that's it. The second you bring a second unrelated business partner into the equation, you're going to benefit from having an actual tax attorney helping with those organizational documents. My old boss, one of my favorite things he ever said is that most people, they make the mistake of approaching marriage without considering their spouse as a business partner. And they approach business partners without thinking about them with the long-term commitment of a marriage. Because the reality is that they are both legal binding documents, and you can get yourself in a lot of trouble if you don't vet out the person that you're working with. And if you don't sort out the specifics ahead of time. So generally speaking, anytime I've got a client where they've got business partners, they are at the level where they need to be having a tax attorney help draft those organizational documents. Sounds like most of you are probably still in the sole owner, whether it's an S Corp or an LLC boat. So you're probably fine with LegalZoom. But that's the big defining factor. So second, we'll talk about tax prep time. So you've got CPAs, your certified public accountants versus TurboTax, or, you know, the guy down the street that does them out of his house, but he's really good, he promises. So where's our big distinguishing factor here? When all you had on your tax return was a W-2, almost nobody can mess that up. I'll say that, you know, there's always caveats. Sure, some people are really talented at messing things up, but generally speaking, if all you have is like a W-2 and your return is that simple, you probably are not going to get much value out of working with a tax professional like a CPA. But if you have a situation where you have a side business, maybe you've got kids, young kids with child tax credits and dependent care credits. Maybe you've got, if you own your own home, if you have any rentals, if you have any of 100 other variables where you really need somebody who's tracking the tax codes and making sure you're not leaving stuff on the table, that's when you want to start looking for somebody who's a little bit more of a legitimate professional. And let's talk about that a little bit deeper for a second, because I know there are a lot of tax preparers out there. So there is a big difference between a CPA, you might see an EA, an enrolled agent, and then there's a lot of people that just have their P10. And the P10, that literally all a P10 is it's basically just when you're preparing tax returns professionally, you have to register with the IRS and they give you a little tax identification number. When you go somewhere like H&R Block, most of the people that are working at H&R Block are only required to have a high school diploma, and they go through usually like maybe about 2 or 3 months of training with H&R Block, and then they're kind of just thrown in and they start preparing tax returns. The next level up, you've got an enrolled agent, an EA, what they're great at. So they also are only required to have a high school diploma, but there are 3 pretty rigorous exams that they have to pass in order to become an enrolled agent. And they are required to have like follow-up continuing education every single year. So they have to keep up their knowledge to like maintain that credential. That is an excellent bet for most people. If you're working with an EA, they're usually very knowledgeable about tax. And then you've got a CPA, and that designation you have to have, depending on when they got licensed, that means they're going to have a bachelor's or a master's degree. They're going to have worked, you know, more than 2 years under another public CPA. And we pass 4 pretty rigorous exams. They actually have a lower pass rate than the bar exam does. Fun fact. It's like one of the most failed professional exams there is. And we also are required to take an ethics exam. CPAs are fun because we're just required to go through all this like ethics exam stuff. And the reason why is that we do have a fiduciary duty to our clients. So that being said, if you guys are past the W-2 stage, which pretty much all of you are, you should be looking for somebody who at a minimum has an enrolled agent designation or a CPA. And then last, and I'll kind of touch on this briefly, wealth management advisors versus a life insurance salesman. And the reason I say that is when I was in my mid-20s, one of the first like financial advisors I started to go to, once you kind of dug through everything that they were telling you, what I realized at the end is they literally get hired to sell life insurance, and then they take a lot of there are a lot of certified financial planner exams that don't require any formal schooling. And it's really just kind of, I think it's like 2 or 3 little tests that they have to take, but it's not like if you do CPA or like enrolled agent, you have to go to an actual Prometric test center versus like their exams that you could just kind of take online to get certified. And one thing that I found now that I'm working at Dark Horse, and we actually have a Dark Horse Private Wealth, we've got like a wealth advisory branch, is the first time you start working with a really legit wealth management advisor, the difference is night and day. The first thing that one of those life insurance salesman advisors is going to have you do is have you check on all your life insurance and this and that and all this stuff, versus your wealth management guy, he's going to be like, okay, well, 90% of rich people are in real estate. Let's talk about real estate. And they're going to take you through like all the things you actually need to like build that element of your portfolio. So definitely some big differences there. But yeah, so I know that obviously is kind of a really big overview. I could probably talk about every single one of those topics for an hour straight. So that's going to be our initial umbrella. And then I'd love to kind of zero in more on some specific questions you guys have some ideas from those intros of what those questions will be, but let's go ahead and open it up and I'll let you guys, yeah, throw some questions at me.
I saw one question in the chat, clarifying about written mileage logs. Would it be outside of the QBO in-app mileage tracking?
Oh,
Someone's-
QBO mileage tracking is fantastic. Highly recommend that. It basically all that means is that you can't wait till you get audited to go use different colored pens to recreate a mileage schedule. It's basically what I'm getting at there. So you just want to be doing it in real time.
Christy O'Brien, you go ahead and ask your question. You still here?
I am. I have like 4 of them.
Awesome. Yeah.
And I don't want to take up everyone's time, so I'm trying to figure out what might be the best one, but I did put them in the chat. Regarding commingling, I use QuickBooks Online. I have a separate business account and I have separate checking account, personal checking account. However, I use one credit card. But when I am categorizing my expenses within QuickBooks, I categorize the ones that are business and I exclude the ones that are personal so that they are separate in terms of, I don't know if that makes sense to you.
Yeah.
Okay. Is that okay? Because
that is, I will tell you, it's incredibly common. More than half my clients are doing that. It's not the worst thing in the world. When we're talking about that gold standard mark, it really is best to eliminate that as much as possible. But that alone, well, and maybe I will say also, like, if you had to guess volume wise, are we talking 50-50? Is it like 20% of them? Just real ballpark.
I think so, probably. Maybe 60-40, 60 personal, 40 business.
Okay. It's definitely, the more you can work on getting that mark to be at least mostly business, the better and better you're going to be just position wise. Because like, if you remember, the real concern here, it's not that you're going to get audited and we're not going to be able to show support for the expenses you took. It's that something's going to happen and you're going to lose. Like if you got sued, for instance, they could undo your liability protection and be like, well, you treated this as your personal piggy bank. You use that credit card. So that's like really where and that's kind of a worst case scenario. Don't freak out too much over that, but
well, and then the other thing too, though, about that, when I pay monthly, my credit card payments, I have a payment coming out of my personal checking account.
Oh, you do?
And I have a payment coming out of my business account. So I am showing and I'm paying toward
Okay.
that from personal as well as business.
You sound like a good client. That is, I would be happy with that all day long because I can't even get that out of most of my clients. So you're probably okay if you're going so far as to actually reimburse it. Because especially when we're talking like about accounting, especially since you're making that payment from your personal account, you're drawing that as essentially netting out to zero. So I think you're okay in that situation.
Okay.
Well done, Christy.
I mean, I don't want to, like I said, I don't want to take up the floor here, but I have other questions. And if anybody else has a question, please go ahead before I go on.
Okay, Cody had his hand up and then Brian, and then I see Kelly, you have something too. Go, Cody.
Yeah. Hi, Sarah. So, my business, I double dip as far as just like what it offers. So I have my whole entertainment side of things, which does incorporate like rental and whatnot, for costumes specifically. But then I also have this other side that is more like AV related. Do, like throwing that all under one umbrella, especially as far as writing off stuff goes, because having both sides of that, it's a pretty broad spectrum of write-offs. But that being said, it's like I can very much justify I use all of this stuff regularly on all of these kinds of gigs that I get. Do you see any kind of an issue with having such a broad umbrella of stuff that falls under what I actually offer as services?
Can you tell me, so when you said entertainment, you do like what, can you expand on that a tiny bit? What kind of entertainment services do you do?
Yes. circus entertainment, so like stilt walking, fortune
Okay.
telling,
Like you
also
personally are the entertainer.
yes, and I also
Okay.
handle staffing as well. So like
Okay.
there's, I'll bring in like a host of circus performers with myself sometimes. Sometimes I'm out of town and I have somebody else hired to manage it.
Okay.
But then I also DJ, so that's another aspect of entertainment. But then I also handle back of house AV kind of stuff as well
Okay.
as graphics, audio, all that kind of stuff. So it's, like I
Yes.
said, very broad.
Very broad, but not as broad as like if you were doing, circus entertainment and also like selling printer paper. So you are kind of generally in the same sort of industry, which is great. So generally the way that we distinguish this, because there's no rule that says you can't provide multiple services in different industries.
Mhm.
Where we distinguish it is you have to remember, especially if you're an LLC, why did you get the LLC? Probably for liability protection. So if you think that there's a risk that you could get sued for doing one service completely unrelated to the other, and it's going to bring down the whole thing because you put them under the same umbrella, that's the concern. So with what you're doing, and especially if it is a low risk area, so it would be different, for instance, like if I have a client that is a physician or a doctor, they are not putting their side gig selling stuff on Amazon under the same thing because they're in such a high liability area. So for your situation, it sounds like you're probably fine. I probably wouldn't be too concerned about it. Once you start getting into the area where you've got multiple six figures happening in either of those, that would maybe be when it would make sense to start splitting those off.
Okay. Kind of tied in with this, when it comes to like gear rental that is associated with either side,
Mhm.
um, that can still kind of fall under the same umbrella. I know that there's the schedule, I was just looking at it, Schedule E that I probably need to incorporate. So
Remind
generally,
me, what's your entity right now?
Coco On Demand Productions, and it's a limited liability, and I'm still a sole proprietor. I have not S
Okay.
corp quite yet.
Okay, gotcha. So that is a good question. So most of the time, Schedule E's, mostly they're used for real estate.
Mhm.
A lot of time, and the other question I have for you is those rentals, are they probably short term? Like it's like less than 7 days at a time?
Yes, exactly.
Okay.
It's honestly
Yeah.
most of the time I'm the one who's operating the equipment, but the equipment is part of the package that I offer as a service.
Yes. Okay. So especially with it being short term rentals are usually considered an active business activity versus most like real estate and long term rentals. It's like passive. So it's actually in separate types of income buckets. So in your situation, I wouldn't see any problems with you running all of that through your LLC right now.
Mhm.
Um, when you start, and this is kind of a question I see on the side also, when your single member LLC, your sole proprietorship, if you start getting into when you're nearing 100,000 of gross receipts, that's when it's time to really seriously start talking about making the S election to start being taxed as an S corporation. And the reason why most CPAs you'll hear that's usually the threshold most people will go with, it's because the second you do become an S corporation, there are some extra administrative costs that come along with it. Number one, you're filing a separate business tax return. That's going to cost money to prepare. Your bookkeeping's got to be clean and beautiful to prepare that return, and you have to put yourself on payroll. So because of that, it's usually right around $100,000 that you're going to get more benefit from taking that leap than from doing it earlier. So,
Awesome. Thank you so much.
mhm.
That was great. So that answered your question, Kelly, I think. All right, Brian, I said you were next. Go for it.
All right. My question is how to find a CPA. I've been looking
Hmm.
for a business coach type person because I'm really looking for somebody to say, this is the software you need. This is how you connect it to the accounting. This is, I'm looking for some direction,
Yeah,
which might be sort of the business attorney and the CPA. And so how do I find these people?
that was a great question. So the number one best way is to find somebody with a similar business as you that you admire and ask them who they're using. That's a great way to do it. Referrals. A lot of CPAs have so much work right now on their plates that they respond a lot better to referrals from an existing client than to cold leads coming in. But that being said, if you are, I mean, a lot of times it does still come down to Google and referrals, I would say is the short answer. I also to expand though, because what you're kind of expressing there. So it's like when you're dealing with a CPA, we do taxes, yes, we do tax planning strategy. We do bookkeeping. So there are several levels to what you can do on the accounting side. So we call it CAS, Client Accounting Services. And the 3 levels you generally have when you're working with a CPA, you've got your baseline bookkeeping and accounting. That's just keeping the record keeping on track. It's having things in place for tax return and planning. The second level is what we would call it like controller services, which is basically like having an outsourced but in-house controller who's helping pay your bills. They're keeping things going. They maybe help run payroll. And then your top service, we call it fractional CFO, which is actually somebody and like, so for instance, I don't provide fractional CFO services, but there's about 5 CPAs at Dark Horse that is all they do because it's such a specialized thing. So they essentially are helping multiple companies get that CFO level advisory, but without having to pay, $150,000 for someone to actually work for you. So probably when you're Google searching, you might want to be looking for like CFO services, outsourced CFO, and that kind of brand rather than just like a generic like CPA.
And that second level was controller?
Controller, yeah, controller. You'll also see it. A lot of people call it office outsourcing, I think is the term they use a lot of times.
Truth be told, I found Dark Horse CPAs ready for this on Nextdoor.
Did you?
I totally did. 2
Yeah.
dudes in a garage. That's how they started, and they were down the street from me. And I just moved, and I had to get my CPA, and I found them. And here we go. 7 years later, I have Sarah. It is 2:00, so I know a lot of you have to run. I can go until 1:15 if you guys want to get some more questions in, if that's okay with you, Sarah.
Yeah, I'm fine.
I did put your information in our chat too, because she obviously knows our business and freelancers and all that. She's been with me for quite a while. So
I'm also happy to Nancy questions we don't get to in the chat. If you guys want to put them in there, I can send the answers to Nancy after too.
Oh, that's awesome.
Don't want to leave you guys hanging. So
no, I know
my whole presentation. Yeah.
I know. Why don't you guys just unmute and ask, and I'll be looking at the.
Do you want to talk about real quick AB 150? That one's popped up a couple times. That might be a good one. So because real quick on the AB 150, I will tell you guys, I've had clients get audited for that specifically. Not a pretty audit. So the deal with the AB 150, the way they're picking people to audit is if a company issues a 1099 to a social security number for an amount that could be a livable wage, that company is going to be on their list to get audited. So your main goal, number one, if you guys do nothing else, get yourself an EIN and fill out the W-9 that you give the companies you're working with under that EIN. And if you're a true sole proprietor, I'd also recommend getting a DBA and doing all your business under the DBA just to really distinguish that. The other thing I will say really quick, if you're only working for a single company, if you can possibly find any other side gigs to work with, that's going to help your case if you get audited, because that's something that they specifically asked for when my client got audited, is proof that that person was actually a business, or do they just work for you and they just kind of got themselves, that's just what they're calling it, So high level, but that's what I would recommend.
Sarah, thank you. That is huge to tempo. And I know Pam is here because Pam works for a production company and has the same audit looming over their head because they're hiring people that do what they do inside the production company. Temple looks at you as a business. You better prove that you're a business. And that's why I do these think tanks, to make sure you guys know you have to be a business. It's general liability. We have the broker for you. It's having a business entity. We've been training you guys how to get your own business entity. It's getting off your social security number. When I look at applications, if I see that you are sole proprietor and it's a social security number, it's not worth it. Like, it takes 2 seconds to go get an EIN, and it's not worth it for you to get hacked and lose everything because your social security number is floating around there. Like, you can go get an EIN for free right now and you'll have it in a second. So do it.
Well, and to add on to that, sorry, hi everybody, Pam again. The AB5 exemptions that are coming out and are being published, it specifically calls out a business license. It depends on where you are in the state, if it's a business tax registration, if it's, there's just a ton of different names. So that was my question there, is that a lot of freelancers are they feel that because they're an S corp that they're exempt from AB5. But looking at that list of criteria, it doesn't say anything specifically about the entity of S corp, and that business license is what seems to bounce off the page that people should get. And it's not it's not a huge expense. Do you agree, Sarah?
Depending on your city, I agree, it's not a big expense.
Okay.
And to expand on that further, thank you for bringing that up, Pam. So number one, if you are an S corporation, corporations aren't required to have 1099s issued to them. So you're literally avoiding that you're not even going to be on their radar if you're an S corporation, because the company doesn't have to send you a 1099. And I will say, my client that got audited, the things that the auditor asked for to prove that those people were businesses, just like Pam said, they asked for business license, they asked for a business card, they asked if they had a website, they really are looking for those indicators that you operate and treat yourself like a business.
Yep. And we did get audited a handful of years ago, and they wanted LinkedIn pages. And
Yes,
they wanted to see
LinkedIn
that
pages.
they wanted to see that you had freelance on your LinkedIn page. So please go do that.
Yeah.
That was one of them too. Yeah. I had to show your websites, your business card, your LinkedIn pages. I had to show almost your underwear drawer. It was horrible.
They also ask
But
for
we won.
invoices, because if you're really a freelancer, you're going to be submitting invoices to the company. So that's another good one. At the minimum, print yourself some letterhead and send off the invoices.
Yep.
Thank you.
I like having you here, Pam. Thank you.
Brian.
Another question. 80% of my business goes through the S corp, but occasionally I get put on a show where they don't want to pay us as an S corp. They want to hire us as a W-2. When it comes time for tax time at the end of the year, what are my liabilities? What do I need to watch out for?
I mean, you're pretty covered there, because if they are, and you really mean W-2, like pay stub, they're taking out the taxes, like you really do mean legit W-2. So you don't really have additional liability there. You're kind of losing the ability to tax plan in the same way, because obviously if you're a W-2 employee, there's virtually nothing you can write off as an employee versus the stuff that you could write off as an S corporation. So it's not really on the liability side, but it's just like, it's not really as great a deal for you tax wise.
Thank you.
Mm-hmm.
Go ahead, Kelly.
Hey, I just have a quick follow-up to my initial question about S corp versus LLC in California. Now that I have the threshold info, being that I'm a former 20+ year W-2 employee just starting my journey, in the meantime, is it best just to stay as I am as a 1099, just like all by myself, or should I get that DBA or LLC in California?
That's a great question.
Yeah.
So I generally encourage my clients, unless this is some little side gig you're planning to abandon next year, I generally suggest you do go ahead and get an LLC.
Right.
Because if you have that LLC in place, a lot of people don't realize that when you make that S election, because like real quick, let's back up, an LLC is considered a disregarded entity. And that means you get to pick how it gets taxed. It could be on a 1040, it could be a partnership, you get to pick. The S election can actually be made late. So if you're an LLC on like January 1st, and we have no idea how much money you're going to make, and then on December 31st, you made like $200,000, we have another year and 15 days, I believe, to go back and make a retroactive S election, and we can actually change it. So that's kind of the big benefit of having an LLC a step ahead of when you need it, is then you've got that flexibility at any point to flip that switch.
That makes sense. And how, I hate to ask this question, how do I set up an LLC? Like, where do I start? Is it LegalZoom, you know?
Well, and yeah, and so if you, so it sounds like you're going to be just single member, it's just you. LegalZoom's going to do just fine for you.
Awesome.
Very simple. You don't need to get into the weeds with an actual tax attorney yet.
Thank you so much. I appreciate that.
And we did a business entity think tank not too long ago. And I will share that link again for y'all about why and when S corp, what's the difference, how are you taxed? It was pretty cool. So I'll look for that right now, but I'll put it in the chat room. I'll put it in Slack too. Temple think tank Slack things. Anybody else want to pop in while I go look for this?
Couple quick questions, just real simple ones that I've heard a couple different things, particularly on going out to location on shows. Per diem a lot has a lot of my clients, so they'll do the GSA rate, or if they do lower, I've heard I can put the GSA rate in. And do I have to have receipts for all of that? And the other part is other expenses that I might incur that the client pays, like flight or maybe hotel or car. Do I run those through and then that's part of my tax deductions?
Yeah. So remind
I'm
me, what type of entity do you have right now, Keith?
S corp. It's an
You are
S
an S
corp.
corp. Okay.
Yeah.
So the per diem rates, really what those are for is it's kind of a benchmark by the IRS to kind of help determine what is a reasonable amount to expect someone to pay. That's how they know if you like booked yourself a flight to Las Vegas and stayed at the fanciest hotel and ate like really fancy dinners, that's unreasonable. So the per diem rates, it's not anything that's so set in stone. It's really just a benchmark more than anything. So as an S corp owner, I mean, any of the travel that you're doing going out to a client, it's going to be deductible, or you're going to be getting it reimbursed from the client. So in either one of those situations, I generally am not concerned about the per diem rate. I'm more concerned that
Okay.
keep your invoices, especially if that was an expensive flight, and just kind of have your trail there. And I think there was one more part to your question.
That was actually the part on
Okay.
that, but I had a question on interest payments. Interest and fees on credit card, my business credit card that I use for flights and other things. Are interest and fees deductible?
100%. That's another great reason not to be commingling, because then if like your credit card is used for business, all of the interest and fees on it are also deductible. And I'll also mention for you, Keith, not to make it a teaser, but as an S corporation, another big benefit of that is you could actually be paying yourself as the business owner a reimbursement each month for the use of your home office and like the use of your vehicle if it's not already in your S corporation. So you kind of have like a whole bucket of things you could be reimbursing yourself for, which gets around the commingling issue. So something else to think about.
Yeah.
Mm-hmm.
Thank you.
Could I piggyback on his question? Because I had a similar one. When you go to Vegas, the per diem is, if they give you 65, you can burn that at breakfast. Because that's not reasonable in Vegas. And so say the rest of your day involves provided lunch and then your dinner is 120, as it usually is.
Yeah.
So the per diem covers your breakfast. I've typically just use that as a food expense, as a business expense, as a separate bucket, essentially. I just wanted to make sure I wasn't doing any kind of weird double dip there.
Yeah, I mean, you're probably fine. So the other thing to keep in mind is like, if you go out and you have a business meal and there's like somebody somewhat business related to you, maybe it's a client or it's like a colleague, you usually have a little bit more leeway in calling that a business meal and it's a business dinner. It's very different than just like sending your employee to a conference and giving them some pocket money. You know what I mean? So and granted, obviously meals, they're only 50% deductible, but it's still, it's better than nothing, especially in Vegas. So
every bit helps.
And in a case like that, if I go out to dinner with a couple colleagues and we each pick up our own, mine is tax deductible. I was out to dinner with them and talking about the show and stuff. I didn't buy theirs. I just bought mine.
Yeah. Yeah, it's still deductible.
It's just consider a meal.
Yeah. That IRS gold standard, very technically, you're supposed to keep a record of who you met with, but most of my clients don't. But yeah.
Yeah, I try to go, oh, who was that?
Yeah.
I know. You'd be surprised how many meals I've had with you, Keith. I'm like writing a name of like, I know 1,200 contractors. How come I can't think of somebody that I sat down with? It's so funny. All right, guys, it's 1:15, so we have to let Sarah go and I have to run as well. But girlfriend, this was awesome.
Thank you so much for inviting me.
Oh my
Thank you
gosh.
very much.
Thank you. I will I'll send you the chat notes, Sarah, so you can look through it if you have anything else you want to send to me. And you guys, I'll respond to this stuff on the Slack channel, in the Temple Think Tank channel, so we don't blow up everything else. But people that are wanted to know about it, we can go to the Think Tank channel on that, whatever, on Slack. You got me? All right.
Awesome.
Thank
you guys so much.
And next month, you guys, my friend who's produced the Olympics ever since Salt Lake, actually Sydney, is going to come join us and talk about Olympics and events and stuff and how to get involved. So there's your teaser. You can come to that one if you want, Sarah.
Okay.
It'll be fun, Pam. Okay. Thanks again, team.
Thank you guys. Have a great week.
Thank
Bye.
you.
With my husband, I guess we are an LLC being taxed as an S corp.
All right. Phew. I think, did I get everybody? Is there a page 2 that I missed? Anybody else? Nope. I think that's everyone. Speak up if I missed you.